big secret for the small investor. A new route to long-term investment success, written by Joel Greenblatt, summarized by Detailed Book Summaries. Don't forget to subscribe. And if you are a returning subscriber, you are welcome. Chapter 1: A Better Mousetrap. If you've ever felt overwhelmed by investing, if you've stared at your 401k or brokerage account and thought, I don't know what I'm doing, and I'm not even sure I'm supposed to, then welcome. You're not alone. In fact, you're the person Joel Greenblatt had in mind when he wrote this book. Right from the beginning of Chapter 1, Greenblatt hits us with a quietly radical idea. Most of what we're told about investing is wrong, or at least wrong for the average person. He doesn't shout it. He's calm, rational, but the message lands like a punch. The system you're being told to trust may not be designed with your success in mind. So he asks a question, not with accusation, but with curiosity. Why does the average investor do so poorly? Why do so many people underperform the very market they're investing in? The answer, he suggests, isn't because individual investors are dumb. Far from it. The problem is the game they're being told to play. It's like being handed a fishing rod with no hook and then being blamed for not catching anything. Greenblatt wants you to know the truth. You don't have to play that game. There's another way, a better way, a simpler, more effective mousetrap. This chapter isn't about giving you that mousetrap just yet. It's about breaking down why the old one doesn't work. It's about peeling back the layers of complexity that have been built around investing layers, designed to make things feel exclusive, opaque, and unapproachable, unless you've got a finance degree or a Wall Street badge. But let's pause for a second. Why would anyone build such a convoluted machine in the first place? Well, think about it. If you're a money manager or mutual fund operator, your income depends on fees on assets under management. Whether your clients win or lose is secondary to how much money you can attract and keep. In that world, activity equals income. Complexity looks like value. And simplicity is dangerous, because if investing is simple, why would anyone need to pay someone else to do it? That's the first crack in the illusion. Greenblatt is asking you to consider something profound, that the complexity of modern investing isn't a feature, it's a smokescreen. And you've been breathing it in for years. Then he does something brilliant. He reminds us that in almost every area of life, hard work pays off. Study more, get better grades. Practice more, become a better musician. Train harder, run faster. That's how we're wired to think. But investing punishes activity. The more you trade, the worse you tend to do. The more you chase, the more you fall behind. It's a rigged game, not in the tinfoil hat sense, but in the psychological one. Your instincts work against you, and the industry does little to help you resist them. In fact, Greenblatt points to a disturbing but well-documented phenomenon. Individual investors underperform not just the market, but even the funds they invest in. Why? Because they buy high and sell low. They chase performance. panic at the bottom and jump in at the top. The problem isn't the vehicle, it's the behavior. And that's where the idea of the better mousetrap starts to make sense. Because if we're honest, most of us don't want to become stock-picking wizards. We don't want to spend our evenings combing through balance sheets or tuning into earnings calls. We just want our money to grow safely, consistently, over time. So the real challenge isn't finding the perfect stock, it's finding a system that works without requiring you to be a genius, and then having the discipline to stick with it. Greenblatt gently but firmly tells us, you don't need to beat the professionals. You need to stop trying to be one. This is where the conversation shifts. He's not just critiquing Wall Street anymore. He's inviting us into something different. A kind of quiet revolution. A world where less is more, where patience is a superpower, and where the best returns come not from being the smartest person in the room, but from removing your emotions from the equation entirely. He doesn't tell you to avoid the stock market. On the contrary, he believes in it deeply, but he wants you to approach it differently. Think systems, not stories. Think rules, not instincts. Think long-term, not today. And if you're wondering whether such a system actually exists, something simple, proven, and accessible, the answer is yes. He's going to show it to you. But not just yet. First, you need to see the trap you're in. Greenblatt highlights how the traditional active fund model is not built for small investors. It's designed to be sold, not to work. Most mutual funds carry high fees, perform worse than the market, and are run by managers who are often more concerned about not losing their jobs than generating long-term results. They hug the index to avoid underperforming too dramatically. They trade too often, and their time horizons are compressed by quarterly expectations and the whims of skittish investors. But here's the twist: you, the small investor, are the one with the true advantage. Think about that. While big funds are forced to move billions of dollars and often can't invest in smaller, more nimble opportunities, you can. While they have to answer to boards, clients, and marketing departments, you answer to no one. You have the rarest asset in all of investing: freedom. You can be patient. You can buy when things are cheap and unpopular. You can hold while others sell. And yet, most small investors throw that advantage away by trying to copy the big guys or chase the next big thing. They forget that their strength lies not in emulating hedge funds, but in being the opposite of them. So what does a better mousetrap look like? Greenblatt hints at it. A system that buys good businesses at bargain prices, avoids the noise, and does the same thing over and over, reliably, mechanically, even boringly. He doesn't reveal the full details yet, but he plants the idea that the path to investment success lies in letting go of prediction and embracing process. In a world addicted to action, that's a radical thought. As the chapter winds down, you get the sense that this isn't just about money. It's about trust, trusting yourself to stay the course, trusting a process over your gut, trusting that the market rewards discipline more than brilliance, That's a hard sell in a culture that worships charisma and speed. But Greenblatt isn't selling charisma. He's selling truth. A quietly subversive truth that small investors can win. Not by playing harder, but by playing smarter. And maybe that's the big takeaway from this first chapter. Not the technical details or the critiques of fund managers, but this one gentle provocation. What if you've been trying too hard to do something that was never meant to be done by effort alone? What if the best investment strategy for you was the one that asked the least of you? Accept patience. As he closes the chapter, you're left not with instructions, but with curiosity. If there's a better mousetrap out there, and it doesn't require luck, genius, or a crystal ball, what would it feel like to build your financial life around it? That's the road ahead. And Greenblatt's going to walk it with you, step by step. Chapter 2, in the beginning. Before you can understand where you're going, you've got to know where you've been. And in the world of investing, that's more than just a cliche. It's a quiet truth most people overlook. In this chapter, Joel Greenblatt doesn't give us a lecture. Instead, he pulls us aside like a thoughtful friend and says, let's take a step back. Let's rewind to the beginning, to how all of this got started. And when you do that, when you go back to the roots of investing, you start to see something important, something most investors today have forgotten. Once upon a time, investing was simple, really simple. You weren't trading tickers on a screen. You weren't flipping through charts or chasing news headlines. You were buying part ownership in a real business. That's what a stock was, not a gamble, not a game, but a claim on the profits and future of a company. That was it. If the company did well over time, you did well. If the company struggled, you felt it in your returns. The connection was direct and logical. But over the decades, something shifted. Slowly at first, then suddenly. Investing became something else. It morphed into speculation. People started buying stocks not because they believed in the underlying business, but because they hoped someone else would pay more for them tomorrow. Stocks turned into chips in a game of musical chairs. Ownership turned into price action. And the original idea that a stock is a piece of a business got buried under layers of noise. It's easy to understand how it happened. The markets got bigger. Technology accelerated everything. Information flew around the globe in seconds. And with all that speed came a new kind of behavior, more emotional, more reactive, more addicted to movement. We went from long-term thinking to minute-by-minute trading, from investing to gambling. Greenblatt doesn't condemn it, not exactly. He just shines a light on the drift. He wants us to understand that what we now call normal in investing is actually quite recent and often quite dysfunctional. Because when you lose that core connection, the one between a business's results and your investment's performance, you stop making decisions based on logic. You start reacting to noise. You follow the herd. You panic when the market falls, and you chase when it rises. You behave less like an investor and more like a contestant on a game show. But what if we went back? What if we reconnected with the original spirit of investing, where buying a stock meant becoming a part owner in something real? Greenblatt nudges us to imagine that. Think about it. If you bought shares in a small bakery in your neighborhood, something you could see and touch and taste, would you check its price every 15 minutes? Would you sell your stake the first time it had a slow month? No, you'd give it time. You'd want to understand how it was run. You'd care about its future. You'd act like an owner. Yet with public companies, we forget all that. A stock goes down 10% and we freak out. The same company, the same cash flows, the same business plan, but we're ready to jump ship because a line on a screen moved in the wrong direction. It's irrational, but it's common. And Greenblatt gently tells us, the problem isn't the market. The problem is our behavior. The roots of all of this go back to people like Benjamin Graham, the godfather of value investing. Graham had this brilliant metaphor. In the short term, the market is a voting machine, swayed by popularity and emotion. But in the long term, it's a weighing machine. What gets weighed? The real value of businesses, earnings, assets, future cash flows, the stuff that actually matters. Graham taught that buying a stock was buying part of a business, and that if you bought it cheap enough, you'd do well, no matter what the market said in the short run. That principle, buy good businesses at fair or bargain prices and wait, is still valid. It has always worked. The trouble is, it's not sexy. It doesn't come with flashing lights or fast-talking analysts. It doesn't give you the adrenaline rush of a big bet that pays off overnight. It's slow. It's methodical. And it requires something most investors struggle with: patience. And that's where this chapter starts to sink in. Greenblatt isn't just giving us a history lesson. He's doing something deeper. He's reminding us of what we've lost and showing us how to reclaim it. He wants us to stop thinking like speculators and start thinking like owners. He wants us to trade the chaos of modern investing for the calm of a rational system. But that's easier said than done. Because everything around us, the media, the apps, the constant stream of information, pushes us toward activity, toward reaction, toward noise. We're told we have to keep up, stay informed, make moves. And yet the data is clear. The more you trade, the worse your results tend to be. The more you try to time the market, the more likely you are to miss its best moments. The more you react, the more you lose. So if doing more hurts and doing less helps, why don't more people take the quiet route? Because it's hard. Not intellectually, emotionally. It's hard to do nothing when the market is swinging wildly. It's hard to stay put when everyone around you is jumping into the latest trend. It's hard to stick with a boring, logical strategy when the world feels like a circus. But that's the path Greenblatt wants to lead us down, the disciplined, repeatable path that works in the long run. The chapter builds to a quiet realization. Success in investing isn't about predicting the future. It's about aligning yourself with timeless principles, about knowing what you're buying, about letting businesses do the work while you stay out of the way. That's what worked in the beginning, and it still works today if you're willing to tune out the noise and stick with it. So as this chapter closes, you feel something shift. The fog begins to lift, you're not just some small investor lost in a sea of confusion. You're someone who's learning to see the game differently. Not as a gamble, not as a race, but as a long, thoughtful walk toward real wealth. One step at a time. That's the power of going back to the beginning. It doesn't just show you where things went wrong. It shows you how to make them right again. Chapter 3, The Big Secret. What if the real secret to investing success isn't about being smarter, faster, or more informed than everyone else? What if it's something far simpler, something hiding in plain sight, quietly waiting for you to stop chasing the noise long enough to see it? That's the idea at the heart of Chapter 3. And once you hear it, it's hard to unhear. Because what Joel Greenblatt reveals here isn't just a strategy. It's a shift in perspective. It's a new lens for thinking about money, markets, and your role in all of it. It starts with a humbling truth. Most investors fail, not because they're not intelligent, not because they don't care, but because they're playing the wrong game. And that game is rigged in subtle ways. We're told that the path to wealth is through activity, through staying on top of every market move, timing our trades perfectly, picking the next big winner. But here's the catch. The harder we try to play that game, the more we get in our own way. We trade too much. We react emotionally. We chase what worked yesterday, only to watch it collapse tomorrow. Greenblatt lays it out bluntly. The average investor doesn't even match the performance of the average fund they invest in. That's right. People consistently earn less than the funds they're in. Why? Because of timing. Because they buy when it feels safe after a run-up, and they sell when it feels scary after a drop. Rinse, repeat, underperform. That's where the big secret starts to come into view. It's not about finding a magic formula that guarantees success. It's about avoiding the mistakes that guarantee failure. And that's something anyone can do. You don't need a PhD in finance. You don't need to watch the market all day. You just need a plan that removes your worst instincts from the equation. Because when you stop making the mistakes that most investors make, emotional timing, overtrading, abandoning strategy, when it underperforms, you're already ahead of the game. And here's the twist that might surprise you. Most professional money managers don't beat the market either. They're smart, sure. They have teams of analysts, models, technology. But the data is clear. Most of them underperform simple index funds over time. Part of that is structural. They charge fees. They often have to hug benchmarks. They're pressured by quarterly results and client expectations. They don't have the freedom to invest the way you do. And that's what Greenblatt wants you to realize. You, the small investor, have an advantage that even the pros envy. You can be patient. You can ignore the noise. You don't need to impress anyone. You can let time and discipline do the heavy lifting. But there's a catch, and it's a big one. Even if you know what works, even if you have access to a proven strategy, sticking with it is hard. Because no matter how smart the approach, it will sometimes underperform. There will be months, or even years, when it looks like it's not working. That's when the real test comes. Can you keep going when it feels like you're falling behind? Can you resist the urge to jump ship just because everyone else is chasing something flashier? That's what separates long-term winners from short-term dabblers. Not intelligence, not insight, just discipline. So what does this better approach actually look like? Greenblatt doesn't spill all the details here that's coming, but he gives you the shape of it. It's a rules-based system, something mechanical, something that buys good businesses at bargain prices and does so without emotion, over and over again. It doesn't rely on predictions or forecasts. It doesn't care what the market did yesterday. It's grounded in logic and backed by data. The real beauty of it. It removes the investor, you, from making impulsive decisions. It replaces your gut with a process. And that's exactly what most people need, even if they don't realize it. Because let's face it, investing is emotional. Money is emotional. It's tied to our sense of security, our dreams for the future, our fear of loss. That's why people abandon good strategies when they hit a rough patch. That's why they jump into hot funds just before they cool off. But if you can take your emotions out of the equation, if you can follow a strategy that's proven to work over time, even when it doesn't feel great in the moment, you can outperform the vast majority of investors. Not because you're lucky or gifted, but because you had the courage to be boring when others were being dramatic. Greenblatt puts it simply, most people lose not because they picked the wrong investments, but because they behaved poorly. The big secret, then, is that better behavior, not better predictions, is the real key to long-term success. It's not sexy, it's not thrilling, but it works. And it works far more reliably than trying to beat the market with your gut. So here's the question he leaves hanging in the air. If you had access to a strategy that worked, not every month, not every year, but over time, could you follow it? Could you stick with it during the cold stretches? Could you ignore the headlines and the hype and just do the right thing quietly and consistently? That's the challenge. That's the opportunity. And that's the secret. It's not that you need to become a different kind of investor. It's that you need to stop trying to be the wrong kind. You don't have to predict the future. You don't have to time the market. You just have to stop making the classic mistakes and follow a system that protects you from yourself. And the best part, you can do it. Anyone can. That's the real secret. You don't need Wall Street. You don't need genius. You just need a plan and the discipline to follow it. Chapter 4, The Best Strategy. What if you could peek behind the curtain and finally see what actually works in investing? Not just the fads, not just the flashy fund manager who's hot one year and cold the next, but a strategy that truly delivers, quietly, consistently, and over time. That's where Chapter 4 opens up. And right from the first paragraph, Joel Greenblatt hits you with the kind of idea that sticks in your head and rattles around for days. What if the best investment strategy isn't new, isn't exciting, and isn't something most people talk about at all? Now that's a question worth sitting with, because here's the uncomfortable truth. Most investors, professional and amateur alike, are chasing the wrong things. They're busy. They're overwhelmed. They're drowning in data and seduced by complexity. But as Greenblatt gently reminds us, the stock market is not a puzzle to be solved. It's more like a game of patience, discipline, and rational behavior. And the people who win that game tend to follow the same path, even if that path isn't glamorous. So what does work? That's the heart of this chapter. And Greenblatt doesn't waste time teasing. He comes right out with it. The best long-term investment strategy is one that focuses on buying good companies at bargain prices. That's it. Simple, right? But don't mistake simple for easy. Because the hard part isn't understanding the concept, it's sticking with it when it doesn't seem to be working. But let's not rush. Let's unpack what that actually means. First, what defines a good company? In Greenblatt's world, it's one that earns high returns on capital. In other words, a business that turns $1 of investment into significantly more than $1 of profit. Think about a corner lemonade stand versus a software company. The lemonade stand might cost $100 to set up and earn $10 a summer. That's okay. But a great business, a truly great business, earns back multiples of what it puts in year after year. It grows efficiently. It scales easily. It has pricing power, loyal customers, and competitive advantages that aren't easy to copy. So that's step one. Find those businesses. Then comes step two. Wait until they go on sale. That's the magic combo, quality plus price. It's what Warren Buffett has preached for decades, what Benjamin Graham outlined nearly a century ago, and what most investors forget when their emotions take the wheel. Greenblatt emphasizes that just because a company is great doesn't mean it's always a great investment. If you overpay, even for a star performer, you're still likely to be disappointed. But if you can be patient, if you can wait for those rare moments when the market misprices greatness, that's where the real opportunities lie. So let's pause here. Why would a great company ever go on sale? Why would the market misprice something so obviously valuable? Well, because the market isn't rational in the short term. It's a voting machine, not a weighing machine, as Graham once said. Stocks go on sale for all sorts of reasons: fear, panic, short-term earnings misses, bad headlines, broader market corrections. The key is not to predict those moments, but to be ready when they happen. To have a system in place that can identify the deals when they show up. Now here, where Greenblatt brings in what he's most famous for, his magic formula. He doesn't go deep into it in this chapter, but he does sketch the idea. The formula ranks stocks based on two simple factors: return on capital, to find the best companies, and earnings yield, to find the cheapest prices. You sort all available stocks by those two criteria, combine the rankings, and invest in the top ones. It sounds almost too easy, right? But that's exactly the point. Greenblatt has tested this approach over decades, across bull markets, bear markets, bubbles, and crashes. And time again, the disciplined, rules-based, value plus quality strategy outperforms the market. Not every year, not even most years, but over time, 5 years, 10 years longer, it crushes most mutual funds, beats the vast majority of professionals, and leaves the average investor far behind. Why? Because it avoids emotion. It avoids timing. It avoids the deadly mistakes that most investors make again and again. But here's the real kicker. Despite how effective the strategy is, very few people stick with it. Why? Because they get bored, or discouraged, or distracted. The strategy might lag the market for a year or two. It might feel like it's not working. And that's when the doubt creeps in. Maybe I need to try something else, you think. Maybe this approach is broken. But it's not broken. It's just being a strategy. And strategies take time. Greenblatt reminds us that even the best systems will go through cold spells. And that's when your conviction is tested. Will you stay the course? Will you trust the data? Will you resist the urge to jump to whatever's hot right now? Because here's the emotional insight that underpins this whole chapter. If you can stick with a good strategy when it's underperforming, you're already in the top 10% of investors. Maybe even the top 1%. Not because you've outsmarted the market, but because you've outlasted everyone else's impatience. Greenblatt tells us that the best strategy isn't the one that feels good. It's the one that works. And it works because it's grounded in logic, not hype. It's based on real business fundamentals, not headlines. It's designed to win slowly and quietly, not explosively, and then collapse. So what does this mean for you, the small investor? It means you don't need to swing for the fences. You don't need to gamble on IPOs or chase tech stocks or try to outguess the Fed. You need a strategy that tilts the odds in your favor. One that buys quality and insists on a discount. One that filters out the noise and keeps you disciplined when everyone else is panicking. And you need to accept that sometimes, maybe even often, it won't feel good. But if you can embrace that discomfort, if you can reframe it as proof that your strategy is doing its job, you will be miles ahead of the crowd. So Greenblatt leaves us with a kind of investing koan, a paradox that takes a moment to absorb. The best investing strategy is one you can actually follow. It's not about brilliance. It's about behavior. Not about predicting the future, but about preparing for it. And most of all, it's about trusting the process. Even when the market tries to tempt, distract, or frighten you off course. That's the real secret behind the best strategy. It works not just because it's smart, but because it's structured in a way that allows you to be smart. Especially when everything around you is pushing you to act foolishly. And in the end, that's the edge that lasts. Chapter 5, The Bad News. So you've discovered the best strategy. You've learned that buying good companies at bargain prices really can beat the market over time. You're feeling confident, maybe even excited. But then Joel Greenblatt drops the other shoe, and it lands hard. Here it is, the punchline. Even the best strategy comes with bad news. Real bad news. Why? Because no matter how sound your investment plan is, no matter how elegant the logic or impressive the track record, you are guaranteed to have long, painful stretches where that strategy just doesn't work. And it's in those moments when everything inside you is screaming, do something, that most people fail. That's the bad news. Greenblatt doesn't sugarcoat it. He doesn't try to soften the blow. Instead, he walks you straight into the fire. Even a brilliant, data-backed strategy like value investing will underperform for years at a time. Not weeks, not months, years. And when it does, you're going to question everything. You'll wonder if the strategy is broken. You'll feel dumb. You'll feel left behind. You'll look at everyone else chasing tech stocks or crypto or whatever happens to be booming that year and think, maybe I'm doing this wrong. But you're not doing it wrong. That doubt, that discomfort, that's part of the deal. Here's the thing most investors don't get. The pain is what makes it work. Let that sink in. The fact that this kind of investing feels terrible at times is exactly why it succeeds over the long haul. Because most people can't take it. They quit. They switch strategies. They sell at the worst possible moment. They break the system. But if you can stick with it, if you can push through the discomfort and hang on during those tough stretches, you'll be one of the few left standing when the cycle turns. And it will turn. Greenblatt uses this chapter to give you a sobering dose of investing reality, the part that most books conveniently leave out. Everyone loves talking about long-term returns. Everyone loves sharing those juicy stats about beating the market. But no one likes talking about the drawdowns, the years of underperformance, the times when you're dead last and can't explain why. And yet, that's where most investors lose their edge. Not because the strategy failed, but because they did. There's a particularly brutal truth that Greenblatt shares here, and it's backed by cold, hard data. Even investors in top-performing mutual funds often underperform the funds themselves. How is that possible? Because they buy high and sell low. They get in after a hot streak and bail after a cold one. It's classic human behavior. We chase winners and flee losers. But investing isn't about feeling good in the moment. It's about what works over time. So Greenblatt urges you to zoom out. Think in decades, not days. Focus on process, not outcomes. And most of all, expect the pain. Build it into your plan. Because when it shows up, and it will, you won't be surprised. You'll be ready. You won't mistake discomfort for disaster. Now, here's the emotional core of this chapter. Greenblatt isn't just talking to your logical brain. He's talking to your future self, the one staring at a red portfolio, wondering whether to pull the plug. And he's telling you, hang in there. This is part of it. Don't panic. Don't flinch. Don't do something just to make yourself feel better. That part hits hard. And maybe you're thinking, okay, but isn't there a way to smooth the ride? Something more comfortable? Greenblatt's answer is simple. Not if you want market-beating returns. Because any strategy that feels good all the time has already been crowded into by others. The returns have been diluted. The edge is gone. Pain is the price of admission. It's the moat that protects good strategies from being overrun. He even gives examples from professional money managers, people with incredible long-term track records who still went through brutal years of underperformance. Some of them lost clients. Some lost credibility. But the ones who stuck to their principles, who stayed disciplined in the face of pressure, came out ahead in the end. And that's what Greenblatt is challenging you to do, to be one of the few. Not because you're smarter, but because you're steadier. Because you know that every successful investment approach has its dark seasons. And if you can simply not quit, you're already doing better than most. Let's use a little metaphor here. Think of investing like planting trees. You don't plant a sapling and expect it to bloom overnight. You water it. You wait. You trust that the roots are doing their slow, silent work. Other people might be buying cut flowers that look great today, but wither tomorrow. Your strategy looks boring by comparison. But 5 years from now, you've got shade, fruit, and a forest growing while they're still chasing bouquets. Greenblatt's message here is timeless and clear. The best strategies are often the hardest to follow. Not because they require special knowledge, but because they require emotional strength, patience, perspective, and a kind of calm confidence that most investors simply don't have. And if you think that sounds hard, well, that's why there's a reward at the end. So yes, the bad news is real. The pain will come. The doubt will creep in. The strategy will look like it's failing. But if you understand that going in, if you know that this is part of how it works, then you'll be ready. You won't be shaken. You'll keep planting. You'll keep watering. And one day, when the trees finally bloom, you'll realize what most people never learn. The best way to win is to not stop playing. Chapter 6, The Solution. By now, you've probably come to terms with the harsh reality of investing. You've accepted that even the most logical, proven strategies don't offer immunity from discomfort. In fact, they require it. You've sat with the truth that success in the market doesn't come from finding the perfect system, but from sticking with one through thick and thin. So naturally, the next question is, okay, what now? What's the answer? And that's when Joel Greenblatt turns the page and gently walks us into the heart of this book. The chapter simply titled, The Solution. Now, don't expect fireworks or magic formulas dressed up as silver bullets. If you followed Greenblatt this far, you know that's not his style. What you'll find here isn't some revolutionary breakthrough. It's not exciting or even particularly new. What it is, however, is grounded, sensible, unshakably rational. And that's exactly what most investors need, a path they can actually follow. So what is the solution? It starts with something refreshingly human. Greenblatt understands that we're all prone to emotional decision-making. That's not an insult. It's just the truth. We panic when markets fall. We chase trends when they rise. We abandon our plans when they underperform. And we convince ourselves we're making smart moves, when in reality, we're just trying to avoid feeling bad. The solution, then, is to build a system that works in spite of our human nature, not because we somehow rise above it. And that system, Greenblatt argues, should be as simple and automatic as possible. Because the more discretion we allow ourselves, the more likely we are to mess it up. Now, you might remember his earlier work, The Little Book That Beats the Market, where he introduced something he called the magic formula. It's a system that ranks stocks based on just two criteria: return on capital and earnings yield. In plain English, it looks for businesses that are both profitable and cheap. It sounds too simple to be powerful, but it works, not because it's clever, but because it's grounded in logic and backed by decades of data. But here's the real magic. It's easy to use. And that matters more than most people realize, because an elegant strategy that you can't follow is worthless. The magic formula, or a similarly rules-based approach, lets you participate in value investing without the gut-wrenching decision-making that trips people up. Yet even Greenblatt acknowledges that following the formula takes a certain temperament. It requires faith in something that will, inevitably, underperform at times. So for those who find even that too daunting, and let's be honest, many of us do, he offers something even simpler. Buy a value-oriented index fund. That's it. No spreadsheets. No rankings. Just a single investment that quietly, consistently applies the very principles he's been teaching, owning good companies at good prices, in a hands-off, long-term way. You might be tempted to scoff at that. An index fund? Really? That's the big secret. Yes, that's the secret. Because simplicity isn't a weakness. It's a superpower. And here, where Greenblatt gets deeply honest, he knows that many investors crave excitement. They want to feel like they're doing something sophisticated, something active. But the reality is, the more you try to be clever, the more you're likely to make emotional mistakes. The less you do, the more you leave your strategy alone, the better your odds of winning. So he lays out two paths. One, you can follow a system like the magic formula, investing in a basket of high-return, low-price stocks on a regular schedule. It's systematic, it's emotionless, and it's proven to work if you stick with it. Or two, you can invest in a smart index fund, one tilted toward value and quality, and just keep adding money over time. No drama, no decisions, just quiet, compounding progress. Either path works. The only real failure is hopping from one to another when things get tough. And that, Greenblatt emphasizes, is the biggest trap of all, the urge to quit when it hurts. The greatest threat to your wealth isn't the market. It's your reaction to the market. The solution isn't just a strategy, it's the ability to stay the course, to believe in the math, to trust the long game. You see, this chapter isn't just about what to buy. It's about who you need to be. You need to be the kind of investor who values process over prediction, who doesn't confuse short-term noise with long-term truth, who's willing to look boring for a while in order to be brilliant over time. That's the real solution, not a product, but a mindset. Greenblatt knows most people will still try to time things. They'll want to tweak the system, bend the rules, add their own special touch. And he's not here to stop them. He just knows that, historically, that behavior hasn't led to better results. In fact, it's usually made things worse. So he urges you gently but firmly to resist the itch. There's a kind of humility in his message. It's not about being the smartest person in the room. It's about recognizing that a smart, simple, rules-based approach, consistently applied, beats brilliance that can't sit still. So what do you walk away with at the end of this chapter? You walk away with clarity. You walk away with a real, doable path, whether it's a rule-based value system like the magic formula, or a smart, passive index fund that leans into the same principles. You walk away understanding that the solution isn't complicated. It just requires courage and patience, and maybe most importantly, the willingness to be ordinary in the short term in order to be extraordinary over the long haul. That's the kind of solution most people overlook, and yet it's the one that works. Chapter 7, the results. So here's the thing. You've been told there's a solution, a way out of the confusion, the noise, the emotional chaos of investing. You've learned that simple, rules-based strategies can help you step aside from your own worst impulses. You've even been given 2 solid paths: the do-it-yourself route, using a disciplined, value-based formula, or the set-it-and-forget-it path with a smart, value-oriented index fund. But deep down, there's still that question lingering in your mind, maybe not spoken aloud, but definitely there. Does it really work? Like, actually? And that's what this chapter is about. Joel Greenblatt knows you don't just want a good story. You want results. You want to see the proof. You want to know if the discipline, the patience, the sometimes uncomfortable commitment to a system actually pays off. So he doesn't sugarcoat it. He doesn't just give you the best years. He shows you the full ride, the good, the bad, and the emotionally exhausting in between. He begins with the magic formula, that deceptively simple approach of buying companies that are both cheap and high quality. High return on capital, low price relative to earnings. Greenblatt explains how, over decades of testing, this formula didn't just beat the market, it crushed it. On average, year after year, it outperformed standard benchmarks like the S&P 500 by several percentage points annually. And over time, those points add up to a massive difference. We're talking life-changing wealth, not in one wild year, but over a disciplined lifetime. But before you get too excited, he throws in a sobering truth. The strategy underperforms, sometimes for a year, sometimes for 2, even 3. There are long stretches when it doesn't look like it's working, when other people seem to be doing better chasing hot stocks or jumping into the latest tech trend. And that's where most people quit. It's a brutal irony. The strategy works precisely because most people can't stomach it, because it's not always comfortable. It doesn't always look smart in the moment. There are going to be times when your portfolio feels like it's stuck in molasses while the market is sprinting ahead. That's the price. Not dollars, emotions. And this is where the real lesson of the chapter comes in. Greenblatt doesn't just want you to know that the results are good. He wants you to understand why most people never get them. It's not because they pick the wrong strategy. It's because they don't stick with the right one. They bail at the worst possible time, usually right before things start working again. It's not a math problem. It's a discipline problem. To drive the point home, he broadens the lens. It's not just the magic formula. Academic studies have shown that value investing, buying cheap stocks based on fundamentals like earnings, book value, or cash flow, has consistently outperformed more expensive, high-growth stocks over long periods of time. But again, that outperformance doesn't come in a straight line. There are whole years, even half-decades, where value lags behind. And that's when people panic. He explains that this cyclical nature is why value works. If it always outperformed, everyone would do it. The opportunity would vanish. What gives value its edge is precisely that it doesn't feel good all the time. You have to be okay with that. More than okay, you have to embrace it, because it's the discomfort that creates the advantage. Greenblatt shows how, when value is combined with quality, not just buying the cheapest stuff, but the best businesses at attractive prices, the results get even better. This blend of cheap and good is rare, and it's exactly what his formula targets. It's not just about getting a good deal. It's about getting a good deal on something worth owning. Still, even with that refinement, the pattern holds. The strategy underperforms at times. And that's what weeds out the majority. The few who hold on, who keep buying, keep believing, keep showing up, they're the ones who get the real reward. Now imagine this. You've been following the strategy for 2 years. The market is up, but your portfolio is flat. Your neighbor won't shut up about how well his crypto is doing. Your cousin bought some trendy AI stock that doubled in 6 months. You feel like a fool. That's when the temptation hits, the urge to tweak, to change, to abandon the plan. And that's the exact moment when most people destroy their long-term returns. Greenblatt is trying to prepare you for that moment. He's saying, you will be tempted. You will feel like quitting. That's the test. And if you pass it, the rewards are extraordinary. He doesn't just rely on his own data. He backs it up with research from top financial minds, showing how patient investors using disciplined strategies beat not only the market, but also the majority of individual investors, even professionals. And he underscores one painful but liberating truth. Most of us are not great investors on our own. We're too emotional, too reactive. That's not a flaw, it's human. But it means we need a structure that protects us from ourselves. That's what the formula does. That's what the value-tilted index fund does. They're not magic because they're brilliant. They're magic because they're followable. They create a space between you and your impulses. And in that space, wealth is built. So what's the real message here? It's this. The results are real. The data is compelling. But the only way you get to enjoy them is by staying in the game. not by being the smartest, not by timing the market, not by constantly adjusting your approach, but by picking a sound strategy and refusing to give up on it, even when every fiber of your being wants to jump ship. Greenblatt isn't trying to impress you with numbers. He's trying to change your behavior. Because if you can stop chasing perfection and instead commit to a plan, an unsexy, reliable, sometimes boring plan, you will likely end up with far better results than 90% of investors out there. And once you internalize that truth, once you see that the emotional cost of discipline is the price of admission to long-term success, you start to think differently. You stop looking for the next big thing. You start looking for ways to stay the course. That's the real result. Not just bigger numbers on a spreadsheet, but peace of mind, clarity, control, and the knowledge that you're finally playing the investing game in a way that stacks the odds in your favor. And that sets the stage for the next piece of the puzzle. How to turn this knowledge into a real-world portfolio you can actually live with. One that fits your temperament, your goals, and your life. We'll explore that in the next chapter. But for now, take this with you. The strategy works, not despite its rough patches, but because of them. The only question is whether you'll be one of the few who can ride through the discomfort and reach the other side. Are you ready to make it real? Then let's talk about the plan. Chapter 8, the plan. At some point in your investing journey, there's this moment, a crossroads. You've done the reading, maybe even spent years jumping from one idea to another, looking for the holy grail of investing. You've made some money. You've lost some. You've wondered more than once, am I doing this right? And then you stumble upon something different, something that doesn't just make sense intellectually, but feels oddly calming. That's where this chapter begins. You see, Greenblatt doesn't just want to hand you theories. He's building you something practical, a plan you can use, not just during the good times, when the market's sailing and everyone's feeling rich, but during the gut-wrenching, confidence-shaking downturns, when your brain is screaming at you to jump ship. This chapter is about giving you the map, not a treasure map to riches, but something more valuable, a way to navigate without getting lost in your own emotions. So here's the heart of it, the plan, the real-world application of everything he's taught up to this point. And it starts with a fundamental truth. Investing success isn't about knowing more, it's about doing less, and doing it consistently. It's about designing a system that works when you're calm and sticking with it when you're not. Greenblatt gives you two options, two distinct, time-tested paths to follow. The first is for the do-it-yourselfer, someone who's willing to spend a bit of time each year, maybe once a quarter, following a rules-based system. This is the magic formula approach. It's simple. Find companies that are high quality as measured by return on capital, and reasonably priced as measured by earnings yield. You rank them. You buy a basket of the top-ranking ones. You hold them. Then you rebalance periodically. Sell off the ones that drop in rank and replace them with new high rankers. That's it. No gut feelings. No crystal ball. no reacting to headlines. It's paint by numbers is investing for people who have realized their emotions are their worst enemy. And over time, this approach, as we've already seen, has outperformed the market by a meaningful margin. But there's a catch. You have to stick with it. Through the boring years, through the underperforming periods, through the phases when your neighbor's meme stocks or AI fads are outshining your boring portfolio. The discipline to not abandon ship, that's the whole game. But what if that sounds like too much work? What if you know yourself well enough to admit that even a rules-based DIY system is a little too hands-on for your taste? That's where Path 2 comes in. Greenblatt's second option is what he calls the value-weighted index fund. And this, frankly, might be the most elegant idea in the whole book. Traditional index funds buy companies based on market cap. The bigger the company, the bigger its presence in the fund. That sounds logical until you realize that means you end up owning more of overpriced, overhyped stocks just because everyone else is doing it. The value-weighted index flips that on its head. Instead of weighting by popularity, it weights by value. You still own a wide swath of the market, hundreds of companies, but the formula ensures you tilt more heavily toward the ones that are cheaper relative to their earnings and cash flows. The ones that tend to outperform over time. It's passive investing with an edge. No trading, no research, just automatic exposure to a portfolio that stacks the historical odds in your favor. And the beauty of this approach, it's practically emotion-proof. You don't need to make decisions. You don't need to check your account weekly. You don't need to second-guess every market dip. You just invest regularly, sit back, and let the system run. Whichever path you choose, DIY with the magic formula, or the low-maintenance value-weighted fund, the real magic isn't in the method. It's in the discipline to stick with it. That's what Greenblatt keeps hammering home. The best strategy in the world means nothing if you abandon it at the first sign of trouble. And trouble will come. The market will fall. Your portfolio will go sideways for a year or two. The media will feed you fear. And in those moments, you'll feel an overwhelming urge to do something. That's the moment the plan saves you. Not because it's clever, but because it was built during a time when you were calm, so you don't have to decide anything when you're not. It's like creating a fire escape plan before the fire. You don't want to be figuring out your exit strategy while the flames are licking at the windows. You want to know in advance exactly where to go and what to do. That's what a good investing plan gives you. The ability to act rationally when everything around you is irrational. And this chapter isn't just about the technical stuff. It's also deeply human. Greenblatt knows the psychology of investing is far more important than the math. He's not just teaching you how to make money. He's teaching you how to avoid losing it through panic, impatience, or ego. Because let's face it, we all want to believe we're better than average. That we can beat the market, time the dips, pick the winners. But most of us aren't wired to do that consistently. And even those who are often burnt out from the stress. What we need isn't a smarter brain, it's a safer framework. That's what this plan offers. Safety, simplicity, sanity. Not by guaranteeing a straight line up, but by removing the need to guess every time the market changes its mood. And in doing that, it frees you from the anxiety that plagues so many investors, the sleepless nights, the second guessing, the endless comparison with others. Greenblatt leaves you with a kind of quiet confidence. Not the flashy confidence of someone who's riding a hot streak, but the durable, grounded confidence of someone who knows they've chosen a plan that works, and more importantly, that they can stick with. So now you've got the tools. You've seen the logic. You've felt the emotional ups and downs. And you've been handed not just one, but two actionable plans that can change your financial life. All that remains is one last question. What really makes all this work? What is the big idea behind it all? The truth that ties the whole book together. That's what the final chapter is for. And it's a good one. Chapter 9, The Big Secret Revealed. You know, when you come to the end of a book like this, you expect some grand revelation, a secret formula, or a magical shortcut that promises riches. But Joel Greenblatt surprises us by saying that the big secret is that there is no big secret. It sounds almost anticlimactic, but that's exactly the point. The truth is simple, even if it feels counterintuitive. Successful investing isn't about outsmarting the market or uncovering some hidden gem. It's about having a system that works, and most importantly, sticking with it through thick and thin. Think about it. How many times have you chased after the latest hot stock or tried to time the market, only to find yourself anxious and uncertain? How often do headlines make you want to act impulsively? Greenblatt reminds us that it's not intelligence that causes investors to fail, but emotions, fear, and greed that cloud judgment. That's why having a clear plan, like the magic formula or a value-weighted index fund, is so crucial. These strategies aren't flashy or complicated, but they tilt the odds in your favor over time. And the challenge is staying the course when everything around you screams otherwise. Market will test your resolve. There will be periods when your portfolio underperforms, and it might feel like everyone else is winning by chasing the newest fad or trend. But success comes not from chasing, but from consistency and discipline. It's about resisting the urge to jump ship when times get rough, understanding that downturns and volatility are part of the journey. This is what separates the winners from the rest, the willingness to hold on to a proven plan even when it's uncomfortable. What's beautiful here is that the best strategy isn't about being right all the time. It's about avoiding the costly mistakes caused by emotional reactions. When you accept that there are no shortcuts or secret codes, you free yourself to invest with confidence, knowing that over the long haul, time and disciplined application of a sound strategy will reward you. So when you step back and think about everything you've learned, from the importance of quality and price to the power of a simple, repeatable system, the real secret shines through. It's not some complex formula or inside tip, but the quiet power of patience and consistency. If you can master that, you've mastered the biggest challenge of investing. In the end, you don't need to beat the market every year. You just need to avoid beating yourself. That's the essence of the big secret. And if you can take that to heart, you're already ahead of most investors. You've unlocked the true secret to building wealth. Steady, disciplined investing without letting fear or greed derail you. And that is truly the best place to be. Thank you for watching. And if you have not subscribed, please do so. See you soon. Chapter 9. The Big Secret Revealed. You know, when you come to the end of a book like this, you expect some grand revelation, a secret formula, or a magical shortcut that promises riches. But Joel Greenblatt surprises us by saying that the big secret is that there is no big secret. It sounds almost anticlimactic, but that's exactly the point. The truth is simple, even if it feels counterintuitive. Successful investing isn't about outsmarting the market or uncovering some hidden gem. It's about having a system that works, and most importantly, sticking with it through thick and thin. Think about it. How many times have you chased after the latest hot stock or tried to time the market, only to find yourself anxious and uncertain? How often do headlines make you want to act impulsively? Greenblatt reminds us that it's not intelligence that causes investors to fail, but emotions, fear, and greed that cloud judgment. That's why having a clear plan, like the magic formula or a value-weighted index fund, is so crucial. These strategies aren't flashy or complicated, but they tilt the odds in your favor over time. And the challenge is staying the course when everything around you screams otherwise. Market will test your resolve. There will be periods when your portfolio underperforms, and it might feel like everyone else is winning by chasing the newest fad or trend. But success comes not from chasing, but from consistency and discipline. It's about resisting the urge to jump ship when times get rough, understanding that downturns and volatility are part of the journey. This is what separates the winners from the rest, the willingness to hold on to a proven plan even when it's uncomfortable. What's beautiful here is that the best strategy isn't about being right all the time. It's about avoiding the costly mistakes caused by emotional reactions. When you accept that there are no shortcuts or secret codes, you free yourself to invest with confidence, knowing that over the long haul, time and disciplined application of a sound strategy will reward you. So when you step back and think about everything you've learned, from the importance of quality and price to the power of a simple, repeatable system, the real secret shines through. It's not some complex formula or inside tip, but the quiet power of patience and consistency. If you can master that, you've mastered the biggest challenge of investing. In the end, you don't need to beat the market every year. You just need to avoid beating yourself. That's the essence of the big secret. And if you can take that to heart, you're already ahead of most investors. you've unlocked the true secret to building wealth. Steady, disciplined investing without letting fear or greed derail you. And that is truly the best place to be. Thank you for watching. And if you have not subscribed, please do so. See you soon.